There is a promise that sits at the very heart of the American dream, a whisper that has echoed through generations. It's the promise of more, the idea that with enough intelligence, with enough hustle, you can amplify your life. You can take what you have, borrow against the future, and accelerate your journey to wealth. It is the gospel of leverage. It's preached in boardrooms, taught in business schools, and sold in late-night seminars. It tells you that smart people use other people's money. That debt is not a burden, but a tool, a sophisticated instrument for the financially savvy. And for decades, the world has believed it. But there is one man, an oracle, sitting in the quiet heart of America, who has built one of the greatest financial empires in human history on a foundation of profound dissent. Warren Buffett believes that promise is not a promise at all. He believes it is a trap. He believes that the gospel of leverage is a siren song, luring the ambitious onto the rocks of ruin. And he has a single unbreakable rule, a philosophy forged in the fires of the Great Depression and tested in every market crash since. It is the one thing he will never do. He will never ever risk what he has and needs for something he doesn't have and doesn't need. He will never hand someone else the power to end his game. And the tool that gives away that power, the instrument that he views not as a sophisticated tool but as a loaded gun pointed at your own head, is debt. This is not a simple story about avoiding credit cards. This is a deep dive into the mind of the world's greatest compounder, a deconstruction of his most fundamental, most contrarian, and most powerful principle. It is a lesson in a forgotten art, the art of financial invincibility. It is the story of the final promise he made to himself, to never let another person's decision take him out of the game, ever. Our journey into this mindset begins not in a skyscraper in New York, but in a small grocery store in Omaha, Nebraska, during the darkest days of the Great Depression. This is the first pillar of Buffett's philosophy, the origin of his aversion, a foundational trauma that shaped his view of capital and risk forever. To understand Warren Buffett, you must first understand his grandfather, Ernest Buffett. Ernest was a man of his time, hard-working, prudent, and deeply embedded in his community. He ran Buffett & Son, a local grocery store that was more than just a place to buy food. It was a cornerstone of the neighborhood. And young Warren spent countless hours there, stocking shelves, sweeping floors, and absorbing the silent lessons of a business built not on grand ambition, but on daily survival. In the 1930s, survival was the only ambition that mattered. The air was thick with fear. Banks were failing, fortunes were vanishing overnight, and the specter of ruin haunted every family. For Ernest Buffett, the greatest enemy was not a competing grocer. It was the ledger book. It was the ever-present threat of owing money to someone you couldn't pay. He operated his store on a principle that was seared into his grandson's mind: absolute financial discipline. He extended credit to his customers, knowing they were struggling, but he was pathologically terrified of taking on debt himself. He had witnessed firsthand how leverage, the so-called tool of the ambitious, had become a guillotine for his friends and neighbors. He saw farmers who had borrowed against their land to buy new equipment lose everything when crop prices collapsed. He saw small businessmen, who had taken out business loans to expand in the roaring 20s, get wiped out by a single bad month, their dreams foreclosed upon by a banker who was just following orders. Ernest taught his son Howard, and by extension his grandson Warren, that debt was a form of servitude. When you owe money, you are no longer your own boss. Your decisions are not your own. You have a silent partner at the table, a partner whose only interest is getting their money back, on their schedule, regardless of your circumstances. This was not an abstract economic theory. It was a visceral, daily reality. Warren saw the anxiety in his grandfather's eyes. He felt the tension in a community where every knock on the door could be a creditor. He learned that the most valuable asset you could ever possess was not a booming stock or a piece of real estate. It was a clear mind, free from the suffocating pressure of owing another man. This deep, almost primal fear of debt was hammered home by a small, personal failure in his own youth. By the time he was a teenager, Warren was already a budding capitalist, a whirlwind of entrepreneurial energy. He had paper roots. he sold golf balls, he installed pinball machines in barbershops. And in one of his earliest ventures, he and a friend bought a used Sinclair gas station. They saw an opportunity, a chance to apply their hustle and make a profit. But they were undercapitalized. They had to borrow, to stretch, to operate on a shoestring. And they learned a brutal lesson. The business was a constant struggle. They were at the mercy of their suppliers. They were vulnerable to the slightest downturn. The weight of their obligations turned what should have been an exciting venture into a source of constant stress. The experience, though small, was formative. It was a real-world confirmation of his grandfather's silent teachings. It proved to him that even with intelligence and hard work, being in a weak financial position means you are playing a different and much harder game. It's a game where you can't afford to make a mistake, where a single stroke of bad luck can be fatal. This wasn't just about personal finance tips. It was about establishing a core philosophy for capital preservation at the earliest age. The lesson was clear. Financial independence, true financial freedom, didn't begin when you were rich. It began the moment you decided to never be beholden to a lender. It was a principle of economic resilience forged not in a bull market, but in the crucible of absolute economic fear. The psychological principle underpinning this foundational trauma is a powerful combination of vicarious learning and fear conditioning. Humans don't need to touch a hot stove themselves to learn that it burns. We can learn by watching someone else get hurt. For young Warren Buffett, the entire American economy was a cautionary tale. He was vicariously experiencing the financial ruin of millions. This wasn't a statistic in a history book. It was the lived reality of the people around him. Every shuttered business, every foreclosed farm, every family struggling, was a data point that fed into a deep, emotional conclusion. Debt is dangerous. This is fear conditioning on a societal scale. Just as a mouse can be conditioned to fear a sound associated with an electric shock, an entire generation was conditioned to fear the overextension of credit. The shock was the Great Depression, and the sound was the whisper of leverage. For Buffett, this conditioning wasn't a phobia. It became a rational, deeply ingrained element of his risk management framework. He understood on a cellular level that the pain of losing is not symmetrical with the pleasure of winning. The anguish he witnessed in his community was a far more powerful motivator than the abstract possibility of amplified gains. This is why his investing strategy, from the very beginning, was biased not towards maximizing returns, but towards eliminating the possibility of a catastrophic, permanent loss. He was playing a different game. While others were asking, "How much can I make?" he was asking, "How can I guarantee I never get wiped out?" This early conditioning explains why Buffett seems immune to the temptations that ensnare so many others. When markets are roaring and everyone is borrowing to chase stocks higher, Buffett's mind doesn't see opportunity. It recalls the lessons from Buffett and Son grocery. It sees the hidden fragility, the silent risk that builds up when optimism eclipses prudence. His aversion to debt isn't just an intellectual preference. It's a baked-in emotional response, a survival instinct honed by one of the most traumatic financial events in modern history. It is a psychological fortress that has proven impervious to the manias and panics of the market for over 70 years. How can we translate this deeply personal history into a practical tool? We can call it the grandfather's grocery store filter. It is an applied mental model for making any significant financial decision, whether it's taking on a business loan, using margin in your brokerage account, or even buying a house. It consists of 3 simple, yet profound questions you must ask yourself before signing on any dotted line. Step 1. Ask yourself, can this decision survive a personal Great Depression? Forget the optimistic projections. Forget what the bank's stress test says. Imagine the absolute worst-case scenario for your life or your business. Imagine your income is cut in half. Imagine your biggest client disappears. Imagine the market for your product dries up for 2 years. In that scenario, does this debt become a guillotine? Does the monthly payment, which seems manageable today, become an impossible burden that could cause you to lose your home, your business, and your savings? If the answer is yes, or even maybe, you fail the test. Ernest Buffett wasn't planning for the best-case scenario. He was structuring his life to survive the worst. This step forces you to build in a margin of safety not just in your investments, but in your entire financial life. Step 2. Ask, does this debt take away my ability to sleep at night? This isn't a soft, New Age question. It is a critical diagnostic tool for risk management. Warren Buffett famously said he never wants to have to worry about the market opening the next day. A core component of building wealth slowly is the ability to maintain rational thought over very long periods. Debt-induced stress is the enemy of rationality. It shortens your time horizon. It forces you to focus on immediate cash flow to service the loan, rather than on the long-term strategic goals of your business or investment portfolio. If the thought of a lender calling you, or the worry about making a payment, is going to occupy even a small corner of your mind, it is a hidden tax on your most valuable asset, your cognitive clarity. True financial freedom is not just about a number in a bank account. It is about a state of mind. It is the freedom from financial anxiety. If a debt compromises that, its true cost is far higher than the stated interest rate. Step 3. Ask, who is truly in control here? Read the fine print of the loan agreement. Look at the covenants. Understand the conditions under which the lender can call the loan or change the terms. With any form of debt, you are granting someone else a degree of control over your future. A mortgage gives the bank the right to seize your house. A business loan comes with covenants that can dictate your corporate finance decisions. Margin from a broker allows them to force liquidate your positions at the worst possible moment. The grocery store filter demands that you see the transaction not from your perspective but from the lender's. They are not your partner. They are a counterparty in a transaction who has legally secured an advantage over you. You must fully understand the power you are giving away. By applying this 3-step filter, you are not just avoiding debt. You are adopting a mindset of radical self-reliance and capital preservation. You are choosing to build your financial life on a foundation of solid rock, just like a small grocery store in Omaha, so that you can withstand any storm the world throws at you. This mindset is the complete antithesis of the modern financial world. The path of the 99% is paved with the glorification of debt. We are bombarded with a constant seductive narrative that portrays leverage as a sign of sophistication. Turn on the television and you'll see advertisements for credit cards offering a lifestyle of travel and luxury, funded by a simple swipe of plastic. The message is clear. You don't have to wait, you can have it all now. This is a direct assault on the principle of delayed gratification that is essential for building wealth slowly. Go online and you'll be targeted by financial influencers and real estate gurus, whose entire business model is based on the idea of using OPM, other people's money. They sell courses and seminars teaching people how to acquire massive portfolios of properties with little to no money down, taking on enormous business loans and personal debt. They frame this as a clever shortcut, a way to hack the system of wealth creation. They are selling a lottery ticket, not an investing strategy. They conveniently omit the stories of those who followed their advice and were wiped out during the last market crash, their highly leveraged empires crumbling like a house of cards. This ethos has even infected corporate finance. The modern CEO is often praised for a lean or efficient balance sheet, which is often a euphemism for a balance sheet loaded with debt and light on cash. The goal is to maximize return on equity in the short term, to please Wall Street analysts. This creates immense fragility. These companies have no buffer, no economic resilience. When a crisis hits, like the pandemic in 2020, they are the first to lay off workers, to seek government bailouts, to face bankruptcy. They have optimized for the best of times, leaving themselves utterly exposed to the inevitable worst of times. The 99% have been taught to see their home not as a place to live, but as an ATM to be tapped through home equity loans. They view student loans not as a serious financial obligation, but as a necessary rite of passage, without fully calculating the decades of indentured servitude that may follow. They chase leveraged ETFs and trade on margin, hoping to turn a small stake into a fortune overnight. In every aspect of modern financial life, the message is the same: borrow, spend, amplify. It is a culture that has forgotten the simple, brutal lessons of the Great Depression. It has forgotten the wisdom of the grocer from Omaha. It is a path that mistakes the appearance of wealth for the reality of it, and in doing so, it leaves the vast majority of people perpetually fragile, perpetually anxious, and perpetually one crisis away from ruin. The direct financial connection between Buffett's aversion to debt and his astronomical success is the simple, beautiful, and unstoppable power of uninterrupted compounding. Let's quantify this. Imagine two investors, Investor A and Investor B. Both are brilliant. Investor A, following Buffett's philosophy, builds a portfolio that generates a steady, unleveraged 15% annual return. Investor B, chasing higher returns, uses leverage to generate an impressive 25% annual return. On the surface, Investor B seems far more successful. But Investor B's use of leverage introduces a small but non-zero risk of ruin. Let's say there is a 95% chance each year that everything goes well, but a 5% chance of a market crash so severe that their leverage wipes them out completely. Let's track their progress over 30 years, starting with $1 million. In year 1, Investor A has $1.15 million. Investor B has $1.25 million. Investor B is winning. This pattern continues for several years. After 10 years, assuming the risk of ruin hasn't hit, Investor A has a respectable $4 million. Investor B has a staggering $9.3 million. The world hails Investor B as a genius. They are celebrated for their aggressive and brilliant investing strategy. But the loaded gun is still on the table. In year 11, a market crash occurs. The 5% chance becomes a reality. Investor B is wiped out. Their net worth goes to zero. They are out of the game. Meanwhile, Investor A, with their fortress balance sheet, weathers the storm. Their portfolio might dip, but they are not forced to sell. They have no margin calls. They survive, and they continue to compound. By year 30, Investor A's portfolio, having chugged along at 15% without interruption, is worth over $66 million. Investor B has zero. This is not an extreme example. It is the mathematical reality of leverage. The potential for amplified returns is always coupled with a risk of total loss. And because you cannot compound from zero, a single catastrophic loss negates all previous supercharged gains. The true financial engine behind Berkshire Hathaway is not just picking great companies. It is the fact that the compounding machine has been allowed to run, uninterrupted, for over half a century. No leverage, no margin calls, no forced liquidations during a market crash. Every dollar earned has been retained and reinvested, creating a snowball of capital that is now the size of a mountain. This is the tangible financial advantage of a philosophy born in a Depression-era grocery store. It is the victory of prudence over brilliance, of resilience over speed. It is the simple math of staying in the game. The second pillar of Buffett's philosophy on debt is more abstract, more mathematical, and arguably even more important. It is the concept of the asymmetry of ruin. This is the stark recognition that a 1% chance of a catastrophic, irreversible outcome is not a risk to be managed. It is an outcome to be avoided at all costs. The modern financial world is built on probabilities. Investment banks, hedge funds, and private equity firms employ armies of PhDs in physics and mathematics to build complex models of risk. They talk about standard deviations, value at risk, and efficient frontiers. But Buffett understands something more fundamental. The real world is not a perfect bell curve. There are fat tails, black swans, events that the models say are impossible but which happen anyway. And when you are leveraged, these events are fatal. For Buffett, the game of investing is not about maximizing the average outcome. It's about ensuring survival under all possible outcomes. This is the critical difference between a path-dependent and a path-independent system, a concept known as ergodicity. A thought experiment illustrates this perfectly. Imagine a game where you have a 60% chance of increasing your net worth by 50% and a 40% chance of losing 50% of your net worth. A traditional financial model would say this is a great bet. The expected return is positive. Over 1,000 parallel universes, the average player would come out ahead. But you don't live in 1,000 parallel universes, you live in one. You only get to walk one path. If you take this bet and hit the 40% chance of loss on the first try, you are significantly impaired. If you hit it twice in a row, you are nearly wiped out. Your path dictates your outcome. Leverage turns the game of investing into a path-dependent, non-ergodic system. A single bad outcome, a single margin call in a market crash, can permanently remove you from the game. Your brilliance, your past successes, all become irrelevant. You cannot recover. This is why Buffett is willing to accept lower, but more certain, returns. He is optimizing for ergodicity. He is ensuring that no single event can ever take him to zero. His primary goal is not to win the game, it is to be able to play the game forever. And if you can play forever, compounding will eventually make you a winner anyway. The most famous and terrifying cautionary tale illustrating this pillar is the spectacular collapse of long-term capital management in 1998. LTCM was not a fund run by amateurs. It was a dream team. Its partners included Myron Scholes and Robert C. Merton, who had just won the Nobel Prize in Economics for their work on options pricing. It included John Meriwether, the legendary bond trader from Salomon Brothers. These were, by any objective measure, some of the smartest financial minds on the planet. Their strategy was to use massive amounts of leverage, borrowed money, to exploit tiny, temporary discrepancies in global bond markets. They believed their models were so sophisticated, their risk management so precise, that they had essentially created a money-printing machine. For a few years it worked spectacularly. They delivered returns of over 40% per year. They were the kings of Wall Street. They managed over $100 billion in assets, with an equity base of less than $5 billion. That is leverage of over 20 to 1. For every dollar of their own, they had borrowed more than 20. They believed they were safe because their bets were diversified across many different countries and asset classes. Their models told them that the probability of all their positions going against them at the same time was infinitesimally small, a once-in-a-billion-years event. Then, in August 1998, Russia defaulted on its domestic debt. This was the black swan. It was the event the models said couldn't happen. A wave of panic, a flight to safety, swept through global markets. All the correlations that LTCM's models relied on broke down. Everything went wrong at once. Their supposedly diversified positions all started losing money, simultaneously and catastrophically. The leverage that had magnified their gains now magnified their losses with terrifying speed. They were receiving margin calls from every major bank on Wall Street. They were being forced to sell assets into a panicked market, which drove prices down further, which in turn triggered more margin calls. It was a death spiral. In the span of a few weeks, the fund lost $4.6 billion. It was completely wiped out. The smartest men in the room had failed to respect the asymmetry of ruin. Their Nobel Prizes couldn't save them. Their complex models were useless against the raw, primal fear of the market. The situation was so dire that the Federal Reserve had to intervene, orchestrating a $3.6 billion bailout by a consortium of Wall Street banks to prevent the collapse of LTCM from taking down the entire global financial system. Warren Buffett was actually called in to potentially participate in the bailout. He made an offer, but it was a lowball one, and it was ultimately rejected in favor of the Fed-brokered deal. But the lesson was not lost on him. He later commented on LTCM saying, "To make money they didn't have and didn't need, they risked what they did have and did need. That is foolish. It is just plain foolish." It was the perfect real-world example of his core thesis. These brilliant men, with PhDs and Nobel Prizes, had made the single dumbest mistake in finance. They took on a small, model-driven probability of a catastrophic outcome, and that outcome occurred. They were erased from the game. Their story serves as a permanent, chilling reminder that no amount of intelligence can protect you from the mathematical certainty of leverage-induced ruin. The psychological principle at play here is a battle between two powerful cognitive forces: overconfidence bias and loss aversion. The partners at LTCM were textbook examples of overconfidence. Their past successes, their academic accolades, their intellectual superiority, it all led them to believe they were different. They believed their models had tamed risk. They thought they were smarter than the market. This is a trap that snares many intelligent people. They mistake their intelligence in one domain for invincibility in all domains. They underestimate the role of luck and randomness in the world, and they overestimate their own ability to predict and control events. This overconfidence leads them to take on risks, like extreme leverage, that a more humble person would shun. On the other side of the equation is loss aversion, the principle discovered by psychologists Daniel Kahneman and Amos Tversky. Loss aversion states that for humans, the psychological pain of losing is about twice as powerful as the pleasure of gaining. A $1,000 loss feels as bad as a $2,000 gain feels good. Buffett's entire philosophy is built around a profound respect for loss aversion. He isn't trying to beat it, he is aligning his strategy with it. He recognizes that the ultimate loss is not losing money on an investment. It is losing the ability to invest at all. Going to zero is an infinitely painful loss because it forecloses on all future gains. Therefore, his risk management is not about minimizing volatility. It is about eliminating any behavior that could lead to that ultimate infinite loss. The 99% of investors are constantly fighting their own psychology. They are swayed by overconfidence during bull markets, taking on margin and leverage to chase returns. Then, when the market turns, the intense pain of loss aversion kicks in, causing them to panic sell at the bottom. Buffett's strategy, by avoiding leverage entirely, short-circuits this destructive psychological cycle. He is never forced to sell. He is never subject to a margin call. This allows him to remain calm and rational during periods of panic, turning market fear into an opportunity rather than a threat. He has structured his financial life to be immune to the emotional whims that destroy most investors. He has conquered the asymmetry of ruin not by being smarter but by being wiser, and by having a system that protects him from his own human fallibility. To apply this pillar, we need a mental model that forces us to confront the possibility of ruin head-on. This is the risk of ruin calculation. It's not a complex spreadsheet, but a series of qualitative and quantitative stress tests to apply to your personal finances or your business. Step 1 is to identify the linchpin. What is the single variable that, if it went to zero, would cause a cascade of failure? For an individual, it might be your primary source of income. For a business, it could be your largest customer or a key supplier. For an investor, it might be the value of a single, highly concentrated stock position that you've borrowed against. You must be brutally honest about your single point of failure. The 99% assume this linchpin is stable. The wise investor assumes it could disappear tomorrow. Step 2 is to trace the leverage chain. For every financial commitment you have, map out how it connects to your linchpin. You have a mortgage, a car loan, and credit card debt. All of these are serviced by your salary, the linchpin. If your salary goes to zero, the leverage chain is activated. The bank can foreclose on your house. The lender can repossess your car. This isn't just about listing your debts. It's about visualizing them as a series of dominoes, ready to fall if the first one is pushed. For a business, it's mapping your business loans to your revenue streams. If your revenue drops by 50%, do your loan covenants get triggered? Does the bank gain the right to seize assets or dictate operations? Step 3 is the black swan simulation. Now, you combine the first two steps and run a simulation. Don't just imagine losing your job. Imagine losing your job during a severe recession where it takes you 18 months to find a new one, and the one you find pays 30% less. Imagine your largest customer goes bankrupt at the same time the credit markets freeze, so you can't get a bridge loan. This exercise is designed to be uncomfortable. Its purpose is to reveal the hidden fragilities in your financial structure. The question is not, can I make my payments today? The question is, what sequence of plausible unlucky events would force me into insolvency? Step 4 is to build your anti-ruin buffer. Based on the simulation, what do you need to survive? The most obvious buffer is cash. How many months of expenses do you need to cover if your income disappears? 6 months is standard advice, but for a true margin of safety, you might need 12 or 24, depending on your risk profile. For a business, it's a war chest of cash on the balance sheet that allows you to operate for a year with no revenue. This isn't dead money, it is survival insurance. It is the price you pay for the ability to play the game forever. By systematically applying this model, you shift your entire approach to personal finance and risk management. You move from a state of unconscious fragility to one of conscious resilience. You stop thinking like a speculator and start thinking like a survivor. The antithesis of this is the efficient market fallacy, an academic concept that has seeped into the consciousness of the 99%. The efficient market hypothesis argues that all available information is already priced into assets, and that the only way to get higher returns is to take on more risk. It presents risk and reward as a neat, linear trade-off. This leads investors to believe that using leverage to buy riskier assets is a smart strategy, because they are being compensated for the additional risk they are taking. The catastrophic failure of Archegos Capital Management in 2021 is a perfect, modern-day example of this fallacy in action. Bill Huang, a former hedge fund manager, ran a family office that made massive, highly leveraged bets on a concentrated portfolio of tech stocks. He used a financial instrument called a total return swap, which allowed him to gain exposure to these stocks without actually owning them, borrowing billions from investment banks like Credit Suisse and Nomura to fund his positions. For a while, as the stocks went up, he made an astonishing amount of money, turning a few billion into an estimated 20 billion. He was taking on enormous, unquantifiable risk, and the market was rewarding him for it, seemingly proving the risk equals reward theory. He was the new genius, but he was not being compensated for risk. He was simply on the lucky side of a coin flip. Then, one of his key holdings, Viacom CBS, announced a secondary stock offering. The stock price dipped slightly. This small dip was enough to trigger a margin call from one of his lenders. Because his positions were so enormous and so leveraged, he couldn't meet the call. The bank then began to liquidate his position, selling off huge blocks of Viacom CBS stock. This selling pressure caused the stock price to plummet further, which in turn triggered margin calls from all his other lenders. It was a repeat of the LTCM death spiral. Within 2 days, Archegos Capital was completely wiped out. The $20 billion fortune vanished. It resulted in over $10 billion in losses for the banks that had lent him the money. Huang, like the partners at LTCM, believed he was managing risk. But he was ignoring the asymmetry of ruin. He was picking up pennies in front of a steamroller. The 99% who follow this path, whether it's through leveraged ETFs, margin accounts, or complex derivatives, are all making the same mistake. They are looking at the upside, at the potential for higher returns, and they are accepting the risk without truly understanding that the risk is not a symmetrical dip in their portfolio. It is the non-zero chance of total, irreversible annihilation. They have bought into a deeply flawed academic model of the world, ignoring the brutal, real-world lesson that Buffett learned long ago. The most important risk to manage is the one that can take you out of the game entirely. The financial impact of this principle is directly visible in a concept called volatility drag or variance drain. This is the cold, hard math of why leverage, even when it doesn't lead to total ruin, is a long-term loser's game. Imagine a stock priced at $100. In year 1, it goes up 50% to $150. In year 2, it goes down 40% to $90. The arithmetic average of the returns is positive 5%, plus 50 minus 40 divided by 2. But what is your actual compound annual growth rate? You started with $100 and ended with $90. You lost money. Your compound return is negative. This gap between the average return and the actual compound return is the volatility drag. Now let's add leverage. Suppose you used 2-to-1 leverage. The 50% gain becomes a 100% gain. Your $100 becomes $200. You feel like a genius. But the 40% loss becomes an 80% loss. Your $200 plummets to $40. Without leverage, you lost 10% of your capital. With leverage, you lost 60%. The volatility drag became a catastrophic chasm. Leverage magnifies the variance of your returns, and mathematically, higher variance directly reduces your long-term compound growth rate. Buffett's obsession with capital preservation and avoiding debt is a strategy to minimize this volatility drag. By investing in stable, predictable businesses and using no leverage, he ensures his path of compounding is as smooth as possible. A lower but smoother rate of return will always, over the long run, beat a higher, more volatile return that is subject to massive drawdowns. When you look at Berkshire Hathaway's portfolio, you don't just see a collection of good businesses. You see a finely tuned machine designed to minimize variance. This is the hidden mathematical engine behind his success. He is not just avoiding the risk of ruin. He is avoiding the insidious, wealth-destroying tax of volatility that leverage imposes on every investor who uses it. This focus on capital preservation ensures that the snowball of wealth he is rolling down the hill almost never shrinks, allowing it to grow to its current, incomprehensible size. The third pillar of Buffett's philosophy is a deep understanding of human psychology, specifically the illusion of control. He knows that debt does more than just introduce financial risk. It fundamentally changes how you think. It hijacks your brain and your business, making you a servant to the lender's timeline, not your own. When you are debt-free, your time horizon can be infinite. You can buy a stock or a business and be prepared to hold it for decades, allowing the value to compound. You can make decisions based on the long-term fundamentals of the business, ignoring the short-term noise of the market. You are in complete control of your own emotional state and decision-making process. The moment you take on significant debt, you surrender that control. You have introduced a ticking clock into the equation. Suddenly, you have to worry about monthly payments, interest coverage ratios, and loan covenants. Your focus shifts from the long-term horizon to the next 30 days. This creates a state of perpetual, low-grade anxiety that degrades the quality of your decisions. You are no longer thinking like an owner. You are thinking like a debtor. This pressure can force you to do things that are detrimental to your long-term success. You might sell a great investment during a temporary downturn simply because you need the cash to service a loan. As a business owner, you might cut back on crucial research and development to make a quarterly earnings number that satisfies your bank. The debt becomes the master, and you become the slave. It dictates your strategy. It sets your timeline. Buffett understands that the single greatest advantage an investor can have is a long time horizon and a rational mind. Debt is a direct assault on both of these assets. It's a self-inflicted wound that cripples your ability to think clearly and act patiently. He believes if you're smart, you will make plenty of money without borrowing. And if you're dumb, borrowing money is just a faster way to go broke. The illusion of control is believing that you can handle the pressure. that you can manage the debt without it managing you. It's the belief that you can borrow your way to prosperity without paying the psychological price. It's an illusion that has shattered countless dreams. A powerful, if slightly nuanced anecdote that illustrates this principle is the saga of Salomon Brothers in the early 1990s. Berkshire Hathaway had become the largest shareholder in Salomon, a legendary Wall Street investment bank, in 1987. Buffett was not managing the firm, but he had a significant investment and a board seat. Salomon, like all investment banks, operated on a razor's edge of leverage. Its business model involved borrowing massive amounts of money, billions of dollars, every single day to fund its trading operations. This was the lifeblood of the firm. They were masters of corporate finance, or so they thought. In 1991, a massive scandal erupted. A rogue trader at Salomon was discovered to have been submitting false bids in U.S. Treasury auctions to corner the market. This was illegal, and the fallout was immediate and catastrophic. The U.S. Treasury threatened to ban Salomon from bidding in future auctions, a move that would have been a death sentence for the firm. It would have cut off their ability to finance their operations. Their lenders, the other banks and financial institutions, began to panic. They threatened to pull their funding. Salomon was facing a run on the bank, a crisis of confidence that, because of their extreme leverage, could bankrupt them in a matter of days. The firm was losing control. Its fate was no longer in its own hands. It was in the hands of the U.S. Treasury and its terrified lenders. In the midst of this crisis, Buffett was forced to step in as interim CEO to save his investment and prevent a systemic financial collapse. He had to fly to Washington, D.C., and personally plead with regulators. He famously told his new employees, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless." What he was truly battling was the terrifying consequence of leverage. The underlying scandal was bad, but it was the firm's reliance on borrowed money that turned a serious problem into an existential threat. The debt gave outsiders, regulators, and other banks the power to pull the plug. Buffett's experience at the helm of Salomon was a masterclass in crisis management, but it was also a visceral, first-hand look at how quickly leverage can cause you to lose control of your own destiny. It reinforced his conviction that relying on the kindness of lenders and the stability of short-term funding markets is a fool's errand. It doesn't matter how smart your traders are or how profitable your business is. If someone else controls your access to capital, they control you. His successful navigation of the crisis solidified his reputation, but the experience undoubtedly deepened his philosophical aversion to ever putting Berkshire Hathaway in a position where its survival depended on anyone else's judgment or mercy. The psychological principle at work here is a devastating duo: the focusing illusion and commitment bias. The focusing illusion is a cognitive bias where people place too much importance on one aspect of an event, causing them to misjudge the bigger picture. When you are in debt, the monthly payment becomes the thing you focus on. It creates a tunnel vision. A business owner with a large loan isn't thinking, "What is the best strategic move for the next decade?" They are thinking, "How do I make payroll and the bank payment next month?" This illusion forces short-term defensive thinking, blinding them to long-term opportunities. You become so focused on not drowning that you don't have the mental bandwidth to navigate towards a safe harbor. This is compounded by commitment bias, also known as the sunk cost fallacy. Once we have committed to a course of action, especially one that involves significant investment or borrowing, we have a deep psychological need to see it through, even if evidence suggests it's a bad idea. An entrepreneur who has taken on massive business loans to start a venture will often continue to pour good money after bad, to double down on a failing strategy, because the alternative, admitting failure and dealing with the consequences of the debt, is too psychologically painful to contemplate. The debt becomes a chain, binding them to their initial decision. Buffett avoids this trap entirely. By operating with a fortress balance sheet, he has no external pressure forcing his focus. He can truly assess every situation with a clear, unbiased mind. If an investment turns out to be a mistake, he can sell it without worrying about how he'll pay back a loan. The most famous example is his eventual admission that the original Berkshire Hathaway textile mills were a terrible business. He didn't borrow money to try and save them. He didn't let his initial commitment blind him. He recognized the mistake and ruthlessly reallocated the capital to better opportunities. This level of rational, detached executive decision-making is a superpower. And it is a superpower that is only available to those who are free from the psychological prison of debt. Financial freedom is not just about having money. It is about having the freedom to think clearly. To apply this principle, we can use a mental model called the owner's manual test. Before you enter into any financial agreement, especially one involving debt, you must ask yourself, am I giving someone else a pen to write a chapter in my owner's manual? Your life, your business, your investment portfolio, that is your machine, and you should be the only one with the owner's manual. Debt is the act of handing that manual to a lender and allowing them to write in a new chapter, a chapter that gives them rights and powers over your machine. Here's how to apply the test. Step 1. Identify the covenant pages. Get the loan document, the credit card agreement, the margin agreement. Don't just look at the interest rate. Read the fine print. Find the sections on covenants, default conditions, and acceleration clauses. This is the chapter the lender is writing. It will detail all the things you cannot do, and all the things that give them the power to change the terms or demand immediate repayment. For a business loan, this could be a clause that says your debt-to-equity ratio can't exceed a certain level. For a margin loan, it's the clause that allows the broker to sell your stocks without your permission. You must understand exactly what powers you are ceding. Step 2. Stress test the lender's chapter. Think like a ruthless, unsentimental lender. Under what conditions would you enforce these clauses? A recession? A dip in your personal income? A bad quarter for your business? The 99% assume the lender will be reasonable and understanding. The wise operator assumes the lender will act in their own self-interest, which is their contractual right. The owner's manual test forces you to acknowledge that you are giving someone else the legal authority to potentially blow up your machine, and they will likely do so at the worst possible time for you. Step 3. Design for invincible ownership. If you must take on a financial obligation, can you structure it to minimize the control you are giving away? For a mortgage, a fixed-rate, long-term loan is infinitely superior to an adjustable-rate one because it removes the lender's ability to change your payment. When negotiating business loans, fighting for looser covenants is more important than fighting for the last tenth of a percentage point on the interest rate. The goal is to keep as much of the owner's manual in your own hands as possible. The ultimate form of this is, of course, to avoid the need for the lender's chapter altogether. By building your financial life around savings, retained earnings, and equity, you ensure that you, and you alone, are the author of your own story. You maintain 100% control, the most valuable asset of all. The antithesis of this is the hustle culture trap, an ethos that has consumed modern entrepreneurship. The narrative is that you must grow at all costs. You must scale. You must move fast. You must dominate your market. And the fuel for this hyper-growth is almost always venture capital or massive business loans. The young entrepreneur is celebrated for raising a huge Series A round, for taking on debt to fund a massive expansion. But what is the reality of this life? It is the complete loss of control. The entrepreneur is no longer their own boss. They now have a board of directors, venture capitalists, and bankers to answer to. Their life becomes a series of board meetings and financial reports. Their brilliant vision, the reason they started the company, takes a backseat to the relentless pressure of hitting quarterly growth targets. Their time horizon shrinks from a decade to 90 days. This creates immense psychological stress. They are living in constant fear of a down round, of a covenant breach, of having to lay off the team they built because they missed a projection. This is not ownership. It is high-stakes management with personal financial ruin as the penalty for failure. Compare this to the alternative path, the bootstrapped founder, the entrepreneur who grows their business slowly, funded by its own profits. They may not get the magazine covers, they may not grow as fast, but they are 100% in control. They answer to no one but their customers. They can choose to reinvest in their product, to focus on long-term sustainability, to build a company that reflects their own values. They own their time, their decisions, and their sanity. The hustle culture sells a dream of rapid wealth and glory, but it often delivers a nightmare of anxiety and servitude. It tricks entrepreneurs into trading their freedom, the most valuable thing they have, for a faster, but far more treacherous path. It is the perfect embodiment of the illusion of control, convincing millions that the chains of debt are actually the wings of ambition. The direct financial connection of this principle can be seen in the hidden costs of debt that never appear on a simple interest rate calculation. The most significant of these is the drain on free cash flow and executive focus. Free cash flow, the cash a business generates after all expenses and investments, is the ultimate engine of long-term value creation. It can be used to pay dividends, buy back stock, invest in R&D, or make acquisitions. It is the lifeblood of a healthy company. Debt service, the principal and interest payments, is a first lien claim on that cash flow. Before a single dollar can be reinvested for growth, the bank must be paid. Let's look at two hypothetical companies. Company A is debt-free and generates $10 million in free cash flow. It can reinvest that entire $10 million to grow the business next year. Company B is the same size but has a large loan that requires $4 million per year in debt service. Its free cash flow is only $6 million. All else being equal, Company A will grow almost twice as fast as Company B. The drag on its compounding engine is enormous. But the cost is even greater. The management of Company B must spend a significant amount of their time and energy managing their relationship with the bank, preparing compliance reports, and worrying about interest rate fluctuations. This is cognitive energy that is not being spent on improving the product, serving customers, or outmaneuvering competitors. This focus cost is impossible to quantify on a balance sheet, but its impact is massive. A management team that can devote 100% of its attention to the business will always outperform a team that is distracted by the demands of a lender. This is why Buffett loves businesses that are self-funding, that gush cash, and require no external capital to grow. He understands that the true financial advantage comes not just from a clean balance sheet, but from a clear-headed management team completely focused on the long-term operational excellence of the business. Debt is a tax on both money and mind. This brings us to the fourth pillar, the proactive, constructive side of Buffett's philosophy. It is not enough to simply avoid debt. You must build an alternative. This is the fortress balance sheet, an unbreakable financial structure designed to be immune to the shocks and panics of the outside world. For Buffett, this is the foundation upon which everything else is built. A fortress has two key characteristics: thick walls and massive provisions. The thick walls of Berkshire Hathaway are its complete and total lack of reliance on short-term funding. Buffett keeps the parent company almost entirely free of debt. He has structured Berkshire so that it will never, under any circumstances, have to ask a banker for money to meet its obligations. This provides an incredible degree of stability and peace of mind. But the true genius of the fortress is its massive provisions, its giant storehouse of supplies. At Berkshire, this is the legendary cash hoard. Buffett insists on keeping a minimum of $20 to $30 billion in cash and cash equivalents on hand at all times. Often, the figure is much higher, sometimes exceeding $100 billion. The conventional wisdom of corporate finance decries this as inefficient. Financial analysts and academics call it cash drag, arguing that this money should be put to work to generate higher returns. They see it as a lazy and unsophisticated use of capital. Buffett sees it as the ultimate strategic asset. He understands that cash has an option value that is impossible to measure in normal times, but which becomes nearly infinite during a crisis. When credit markets freeze, when asset prices are collapsing, when everyone else is panicked and forced to sell, Berkshire's cash hoard transforms from a defensive shield into a powerful offensive weapon. It allows him to be the buyer of last resort, to provide liquidity to the market on his own terms, and to acquire world-class assets at bargain basement prices. The fortress is not just about survival, it is about having the strength to conquer when others are falling. The foundational anecdote for this pillar is the story of how Buffett discovered the magic of insurance float. This was the key that unlocked his ability to build the fortress. In 1967, Berkshire Hathaway, still a struggling textile company, acquired National Indemnity Company, a small Omaha-based insurance firm. On the surface, it seemed like an odd move, but Buffett had seen something that others had missed. He had realized that an insurance company operates on a unique and wonderful business model. You collect premiums from customers today for accidents that may not happen for months or even years. In the meantime, you get to hold and invest that money for your own benefit. This pool of money, the premiums collected but not yet paid out in claims, is called float. And Buffett realized that float was the ultimate form of leverage, a form of good debt. It was other people's money that he could use to invest, but it had two incredible advantages over conventional debt. First, it often had a negative cost. If the insurance business was run well, the premiums collected would exceed the claims paid out, resulting in an underwriting profit. In this case, he was literally being two law-pads to hold and invest other people's money. This is the polar opposite of a bank loan, where you are paying interest for the privilege of using the money. Second, and most importantly, it could never be called away from him. A customer can't come to National Indemnity and say, "I'd like my auto insurance premium back, please. I've decided not to have an accident this year." As long as the business kept writing new policies, the pool of float would remain stable or even grow over time. It was permanent, long-term capital with no covenants and no repayment date. The acquisition of National Indemnity and other insurers transformed Berkshire Hathaway. It provided a gusher of ever-increasing float, which Buffett could then deploy into stocks and whole businesses. This was the raw material for his fortress. He was using a form of leverage, but it was leverage without the risk of ruin. It was leverage on his own terms. This discovery was the financial engine that powered Berkshire's ascent from a dying textile mill to the global conglomerate it is today. It allowed him to build a capital base of immense size and resilience, completely independent of the whims of Wall Street banks or the panic of the credit markets. It was the masterstroke of a financial architect building a structure designed to last for centuries. The underlying psychological principle behind the fortress balance sheet is the profound power of a margin of safety. This concept, first articulated by Buffett's mentor Benjamin Graham, is typically applied to stock valuation. It means buying a stock for significantly less than its intrinsic value to provide a buffer against bad luck or miscalculation. Buffett took this core idea and applied it not just to the assets he was buying, but to the entire structure of his enterprise. The massive cash hoard, the minimal debt. This is a margin of safety applied to corporate finance. The psychological benefit of this is immeasurable. It creates freedom from anxiety. Because Buffett never has to worry about the survival of his enterprise, he can dedicate 100% of his cognitive resources to making smart, long-term capital allocation decisions. He doesn't have to react to market noise. He doesn't have to appease anxious bankers. He can operate with a level of patience and rationality that is simply impossible for a leveraged CEO or investor. This is the foundation of what Charlie Munger calls the psychology of misjudgment. Most financial errors are not intellectual, they are emotional. They are the result of fear and greed. The fortress balance sheet is a structure designed to neutralize those destructive emotions. It is a psychological shield. When the world is consumed by greed, Buffett's cash hoard feels like an anchor, preventing him from overpaying for assets. When the world is paralyzed by fear, his cash becomes a source of immense confidence and opportunity, allowing him to act decisively while others are frozen. It allows him to be greedy when others are fearful, and fearful when others are greedy. This famous maxim is not just a clever saying. It is an operational principle that is only possible for an entity that has achieved a state of complete financial and psychological independence. The fortress provides this independence. We can translate this into the Financial Fortress Blueprint, a practical guide for building this resilience into your own personal or business finances. It's a multi-stage process. Stage 1 is plug the leaks. Before you can build a wall, you must stop the outflow. This means aggressively paying down and eliminating high-interest, non-strategic debt. This is your credit card debt, your personal loans, anything that is a constant drain on your cash flow. This is the financial equivalent of demilitarizing your borders. You are removing internal threats before you start building external defenses. This requires intense financial discipline, but it is the non-negotiable first step. Stage 2 is build the moat. The moat is your emergency fund, your liquid cash reserve. For an individual, this is the classic 6 to 12 months of living expenses held in a completely safe, accessible account. For a business, it is a cash reserve sufficient to cover payroll and essential operating expenses for a significant period, e.g., 6 months, with zero revenue. The purpose of the moat is to absorb the initial shock of any crisis, a job loss, a medical emergency, a sudden recession. It ensures you will never be forced to sell productive assets or take on predatory debt in a moment of panic. Stage 3 is construct the keep. The keep is your core investment portfolio, the engine of your long-term wealth creation. Following Buffett's principles, this should be built on a foundation of equity in high-quality, productive assets. For most people, this means low-cost index funds or a portfolio of carefully selected, durable businesses. The key is that this capital is yours, free and clear. It is not margined, it is not leveraged. It is the solid stone at the center of your fortress. Stage 4 for the advanced operator or business is to develop the counteroffensive capability. This is the surplus capital, the cash hoard that exists above and beyond your emergency fund. This is your opportunity fund. Its purpose is to sit patiently, sometimes for years, waiting for a moment of extreme market dislocation. When the next market crash occurs, this is the capital you will deploy to buy world-class assets at discounted prices. This is how you turn a crisis from a threat into a generational wealth-building opportunity. By following this blueprint, you are systematically transforming your financial life from a fragile, vulnerable structure into a resilient, powerful fortress capable of withstanding any storm and capitalizing on the inevitable folly of others. The antithesis of this is the just-in-time balance sheet, the dominant philosophy in modern corporate finance, and, by extension, in the personal finances of the 99%. The just-in-time methodology originated in manufacturing. It's the idea of keeping inventory as low as possible to maximize efficiency and reduce carrying costs. This concept was then applied to the balance sheet. A just-in-time balance sheet keeps cash to an absolute minimum. Any surplus cash is immediately returned to shareholders through buybacks or dividends, or it's used to pay down debt. The company then relies on lines of credit and other short-term debt facilities to manage its day-to-day cash flow needs. This is praised by Wall Street as efficient capital management. It juices short-term metrics like return on equity. But it creates extreme fragility. A company with a just-in-time balance sheet has no buffer. It is optimized for a perfect, stable world. The moment a crisis hits, a credit crunch, a supply chain disruption, a global pandemic, it is immediately in trouble. Its lines of credit may be pulled. Its access to capital markets may disappear. It has no internal resources to fall back on. This is why, during the 2008 financial crisis and the 2020 pandemic, so many large, seemingly successful corporations were instantly on the brink of collapse, begging for government bailouts. Their efficiency had come at the cost of resilience. The same is true for the individual who lives paycheck to paycheck. They are running a just-in-time personal balance sheet. They have no moat, no keep. A single unexpected car repair or medical bill can send them spiraling into credit card debt. They are perpetually fragile, one unlucky event away from disaster. This path of the 99% prioritizes short-term optimization over long-term resilience. It is a system designed to look good on paper in the best of times, but it is a blueprint for catastrophic failure when times get tough. It is the exact opposite of the fortress mentality. The direct financial connection and the ultimate power of the fortress balance sheet is its ability to generate what we can call the crisis alpha. Alpha is a term for returns that are above and beyond the market average. Most hedge funds try to generate alpha through complex trading strategies. Buffett generates it by being patient and then acting with overwhelming force when the opportunity is greatest. The 2008 financial crisis provides the most stunning example. As the global financial system was melting down, as Lehman Brothers was collapsing, as panic was gripping every market, Berkshire Hathaway was a sea of calm. Its fortress was untouched. Buffett had over $40 billion in cash ready to deploy. While other institutions were desperate for capital, Buffett was the one person who had it, and he used it to strike some of the greatest deals in financial history. He invested $5 billion in Goldman Sachs in the form of preferred stock that paid him a 10% annual dividend. That's $500 million a year guaranteed, plus warrants to buy their common stock at a low price. He made a similar deal with General Electric, investing $3 billion. He invested billions more in Bank of America. These were not stock purchases on the open market. These were bespoke deals that were only available to him because he was the only one with the capital and the reputation to be a credible partner in that moment of extreme fear. He was not a seller in the panic. He was the provider of liquidity. He was the lender of last resort. Over the next few years, Berkshire Hathaway made more than $10 billion in profits from these crisis-era investments alone. This is the crisis alpha. It is a return that is not available to leveraged investors. It is not available to those running a just-in-time balance sheet. It is a direct, quantifiable financial reward for decades of financial discipline, for maintaining a fortress, for having the courage and the resources to be greedy when others are fearful. The inefficient cash hoard turned out to be the most valuable and productive asset he owned, generating returns that no spreadsheet could have predicted, simply by being available at the right time. This leads us to the fifth and final pillar, the philosophical capstone of Buffett's entire system. It is the path of the patient compounder, a radical redefinition of what it means to be smart in a world obsessed with speed and leverage. The modern financial ethos equates intelligence with complexity and speed. The hedge fund manager with a complex algorithm, the private equity titan using elaborate debt structures, the trader making 100 moves a day, these are the figures held up as the geniuses of the financial world. Their goal is to get rich quick. Buffett's entire career is a quiet, devastating refutation of this idea. He argues that true intelligence in investing is not about finding a shortcut. It's about finding a powerful, inevitable trend, the compounding of value in great businesses, and then having the discipline and patience to stay on that path for an entire lifetime. This requires a fundamental shift in mindset. You must stop seeing the market as a vehicle for speculation and start seeing it as a vehicle for ownership. You are not buying a ticker symbol that you hope goes up. You are buying a fractional ownership stake in a real business. And if you have chosen a great business, the most powerful thing you can do is nothing. You let the managers of that business do their work. You let the profits be retained and reinvested. You let the magic of compounding work its slow, silent, unstoppable miracle. This approach seems simple, even boring, to the 99%. It lacks the thrill of a big, leveraged bet. It doesn't provide the dopamine hit of a quick trading profit. It is the financial equivalent of watching paint dry. But this boring approach is precisely why it is so powerful. It protects you from the single greatest destroyer of wealth, yourself. It prevents you from making emotional decisions, from chasing fads, from overtrading, and most importantly, from using leverage to try and force a result that time itself will deliver for free. Buffett's genius is not that he is a better stock picker than everyone else, it's that he has mastered the art of inactivity. He has the emotional fortitude to let his good decisions play out over a 50-year time horizon, a period so long it is almost incomprehensible to the modern mind. This is the path of the patient compounder. It redefines smart not as the ability to generate the highest return next year, but as the ability to create a system that can generate good returns forever. The perfect story to illustrate this pillar is the acquisition and ownership of See's Candies. In 1972, Charlie Munger convinced a reluctant Warren Buffett to buy a high-end chocolate company based in California. The asking price was $30 million. Buffett, still deeply schooled in the cigar butt investing of Ben Graham, thought it was too expensive. The company had only $8 million in tangible assets. He was being asked to pay a huge premium for the brand, for the goodwill, an intangible asset that made him uncomfortable. But Munger prevailed, convincing him that it was better to pay a fair price for a wonderful business than a wonderful price for a fair business. They bought See's for $25 million. And then, they did something revolutionary in the world of corporate finance. They largely left it alone. They didn't load it with debt to optimize the balance sheet. They didn't try to franchise it aggressively across the country. They didn't replace management. They recognized that they had purchased a small, perfect jewel of a business. It had a loyal customer base, a powerful brand, and pricing power. It also had a wonderful economic characteristic. It required very little capital to grow. It was a cash-generating machine. Over the years, See's Candies has sent its profits back to Omaha, to the Berkshire Hathaway parent company. How much? To date, See's, a company they bought for $25 million, has generated over $2 billion in pre-tax earnings for Berkshire, almost all of which required no additional capital investment. It was a gusher of cash that Buffett could then use to buy other wonderful businesses. The story of See's is the perfect counter-narrative to the leveraged buyout model. A private equity firm would have bought See's, loaded it with business loans, aggressively expanded, cut costs, and then tried to flip it 5 years later. They might have made a quick profit, but they would have killed the golden goose. Buffett and Munger chose the path of the patient compounder. They paid a fair price, took on zero debt, and simply let the wonderful business be wonderful for 50 years. This decision, this commitment to long-term unleveraged ownership, is the very essence of their success. It demonstrates a form of business intelligence that is deeper and more profound than the spreadsheet-driven financial engineering that dominates the modern world. It is the wisdom of the farmer, not the hunter. You don't eat your seed corn, you plant it, tend it, and let it grow. The psychological principle that Buffett masterfully overcomes here is hyperbolic discounting. This is a cognitive bias where humans have a strong tendency to prefer smaller, immediate rewards over larger, later rewards. We are wired for the short term. We would rather have 1 cookie right now than 2 cookies in an hour. This is the instinct that drives consumerism, credit card debt, and speculative trading. The allure of a quick profit, the desire to get rich now, is a powerful, primal urge. Hyperbolic discounting is why the 99% are so susceptible to get-rich-quick schemes and leverage strategies. These schemes promise to compress the timeline of wealth creation. They offer the cookie of a 50% gain next month, and it feels more tangible and exciting than the promise of a 15% compounded return over 20 years, even though the latter is the path to true, sustainable wealth. Buffett's entire operating system is a triumph of deferred gratification. He is a master at overriding this basic human instinct. His ability to think in 50-year increments is what sets him apart. He is playing a different game on a different time scale. This is not something he was born with. It is a learned discipline. He has created a set of rules and a business structure that forces this long-term perspective. His 20-slot punch card analogy is a perfect example of this. He tells students to imagine they have a punch card with only 20 slots in it, representing the total number of investments they can make in their entire lifetime. This mental model forces extreme selectivity and a powerful long-term commitment. You wouldn't use one of your precious 20 slots on a speculative leveraged bet. You would only use it on an investment you understood deeply and were prepared to hold for a very, very long time. By artificially constraining his own choices, he defeats the impulse for short-term action and aligns his behavior with the long, slow, powerful arc of compounding. He has successfully rewired his brain to value the 2 cookies tomorrow far more than the 1 cookie today. To apply this, you can use the 20-slot punch card compounding method as your own investing strategy. This is a powerful mental model to cure you of the short-termism that plagues most investors. Step 1. Get a physical index card and draw 20 circles on it. This is your card. Every significant investment decision you make for the rest of your life gets 1 punch. This is not for small trades. This is for the core positions that will build your wealth. The physical act of having a card makes the scarcity real. Step 2. Before you can punch the card, an investment must pass a series of rigorous tests. First, the circle of competence test. Do I understand this business inside and out? Can I explain how it makes money and why it has a durable competitive advantage? If the answer is no, you cannot punch the card. This immediately eliminates 99% of the market and forces you to focus on what you know. Second, the 10-year test. Am I willing to own this business for the next 10 years, even if the stock market closes for that entire period? This forces a true ownership mindset and eliminates the temptation to trade based on short-term news. Third, the no leverage test. Is this a business with a strong balance sheet that doesn't rely on debt to generate its returns? This ensures you are investing in resilient, high-quality enterprises, not financially engineered contraptions. Step 3. Punch the card and hold. Once an investment passes these tests, you make your investment, and you punch the card. Now comes the hardest part, doing nothing. You have made a long-term commitment. You must resist the urge to constantly check the stock price, to listen to market chatter, to sell because of a temporary setback. You have punched your card. Your decision is made. This method is a powerful form of financial discipline. It transforms investing from a frantic, speculative activity into a slow, deliberate, and thoughtful process of acquiring ownership in great businesses. It is the ultimate antidote to the leveraged lottery ticket mentality. It forces you to adopt the mindset of a patient compounder. The antithesis of this path is the lottery ticket mentality that defines the behavior of the 99% in the modern market. Fueled by commission-free trading apps that have gamified the investing process with confetti and social media-like features, a new generation of market participants has been taught to see the stock market not as a mechanism for capital allocation, but as a giant casino. Their tools are not patience and financial statement analysis. Their tools are leverage and speculation. They trade options, a form of implicit leverage, making all-or-nothing bets on short-term price movements. They use margin accounts to amplify their exposure, often without understanding the risk of a margin call. They pile into meme stocks based on social media hype, completely divorced from the underlying fundamentals of the business. They are not trying to build wealth slowly. They are trying to hit a jackpot. They are trying to turn $1,000 into $1 million overnight. This mentality is a direct consequence of a culture that has lost its respect for the process of compounding. It is a product of hyperbolic discounting run amok. The tragedy is that this path almost always leads to ruin. For every one story of a lottery winner, there are millions of stories of people who have lost their savings, blown up their accounts, and become disillusioned with the very idea of investing. They see the market as a rigged game because they were playing the wrong game all along. They were playing the game of speculation, a zero-sum game of trying to outsmart other speculators. They were not playing the game of investing, the positive-sum game of owning a piece of the productive capacity of the economy and letting it grow over time. The lottery ticket mentality, fueled by easy access to leverage, is the fast lane to financial destruction. It is the polar opposite of Buffett's slow, steady, and certain path to unimaginable wealth. The direct financial connection of this patient, unleveraged approach is found in the way it allows an investor to capture the true, long-term return on equity of a great business. Let's look at 2 companies, both with a high return on equity, ROE, of 20%. Company A is a high-quality business like C's Candies. It has a great brand, pricing power, and requires little capital. Its 20% ROE is generated organically from its excellent business operations. It has no debt. Company B is a mediocre, capital-intensive business in a competitive industry. Its natural ROE is only 8%. To get its ROE up to 20% to impress investors, it has taken on a huge amount of debt. The leverage magnifies its small profits into a high ROE figure. On the surface of an income statement, they might look similar. Both are 20% ROE companies, but they are fundamentally different. Company A is a durable, cash-gushing machine. Company B is a fragile, ticking time bomb. The patient compounder buys Company A and holds it for 30 years. Over that time, the value of their investment will compound at a rate very close to that 20% ROE, as the business retains its earnings and reinvests them at that high rate. The speculator attracted by the high ROE might buy Company B. For a few years, it might do well, but eventually a recession will hit. The mediocre business will struggle. The debt load will become an unbearable burden. The company may go bankrupt, and the stock will go to zero. By focusing on the quality of the business and the absence of leverage, the patient compounder is able to capture the full, explosive power of long-term business compounding. The speculator, fooled by the financial engineering of leverage, ends up capturing a 100% loss. This is the ultimate financial payoff of Buffett's philosophy. It is a system for identifying and owning the true, durable engines of wealth creation and distinguishing them from the fragile, debt-fueled illusions that fool the 99%. It is the final, elegant connection between his aversion to debt and his astronomical success. You have just spent this time internalizing a profoundly powerful and contrarian idea. You have learned the single rule that underpins the entire financial empire of the world's greatest investor. It is not a stock tip. It is not a complex formula. It is a philosophy of survival and resilience. You now understand that true wealth is not built by chasing amplified returns, but by systematically eliminating any possibility of ruin. You have acquired the mental tool to see debt not as an instrument of opportunity, but as the surrender of control, a loaded gun that you must refuse to ever point at your own head. This principle of capital preservation is the unbreachable defense, the foundation of the entire Berkshire Hathaway fortress. But a fortress is more than just its walls. An invincible defense is only half of the equation. Buffett's system is a network of interconnected mental models, a perfect union of defense and offense. The aversion to debt is what guarantees he stays in the game. But what he does once he is in the game, how he identifies the opportunities that others miss, how he deploys his capital with such devastating effectiveness during times of crisis, that is a completely different set of mental tools. You have just mastered the shield, but you have not yet learned how to wield the sword. You understand the why not, but the how-to of his actual investment selection is a story of its own. The video that is on your screen right now is the other half of the map. It is the missing link. It is the bridge between the principle of not losing money and the practice of making extraordinary amounts of it. It explains the offensive strategy that Buffett's impenetrable defense makes possible. It is the crucial next piece in understanding how these principles lock together to form a complete, cohesive system for a lifetime of successful compounding. To stop here is to have a shield with no sword, a wall with no army. To understand one without the other is to miss the true genius of the entire methodology. Most people will learn one trick, one idea, and think they have the answer. But the true architect of their own financial destiny, the serious student of wealth, understands that success lies in building a complete mental arsenal. The choice to click is not about watching another video, it is a declaration. It is a commitment to continue your ascent, to assemble the full toolkit, to move beyond defense and master the art of the attack. The next piece of the system is waiting for you. The only question is whether you are ready to complete what you have started.